Today is Monday, June 24th, and this is the ADM Investor Services Weekly Market Kickoff. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, Vice President of Grain Research. Alan, U.S. stock index futures are closing in on record highs. How is this possible in light of the unresolved U.S.-China trade issues and the ongoing U.S.-Iran tensions?
Well, the feeling was several months ago that stock index futures would continue to be under pressure as long as there was no trade agreement. That seemed to be the prevailing view. Since then, though, we have seen pressure from central banks to lower interest rates, and that seems to be the dominant influence, even overriding the trade situation, as important as that is. So that in itself suggests that stock index futures will remain well supported as traders focus on central banks likely to ease credit even further.
And what is the outlook for the U.S. dollar?
Well, the dollar index seems to be coming under some pressure, and the main reason for that is that as of last week, the Fed seems to be a bit more accommodative than they had indicated earlier. So the Fed is likely to lower rates faster than other central banks, and that is a recipe for lower prices for the dollar index.
And last week, gold futures advanced to a highest level in over 5 years. Why has gold been so strong in spite of limited global inflation?
Well, that's kind of a mystery. No inflation anywhere to speak of, and usually the gold market is very sensitive to inflation. Of course, we do have some geopolitical tensions, but in the past, geopolitical tensions have been a negative on the gold market, with the idea being that geopolitical problems would slow the global economy. A slowing global economy means less inflation. So I think there's more than just what's going on with the U.S.-Iran tensions being a supportive influence to the gold market. Keep in mind that central banks last year bought more gold than they have in the last 50 years. So gold moving into strong hands suggests maybe the central banks are seeing something down the road. I'm not sure what that might be. Maybe inflation at some point in years ahead. So with that in mind, gold overperforming the news in itself suggests that higher prices are in store for the gold market, and I would continue to trade that market from the long side.
And Steve, on to grains. These corn futures made new highs, but may be running into some resistance. What is the latest on planted corn acres, yield, and carryout, and what impact will it have on prices?
Well, we've seen an unprecedented rally from the May lows of $1 per bushel for Dees corn. We're now trading around the 470 area. There's talk that we may lose somewhere between 4 and 10 million acres due to the wet weather. USDA in June came out with a yield of 166, which was below trade expectations. It could put the carryout as low as 1,200. And I think that we're seeing cash basis levels, especially in the East, go higher because the end user is panicking. He didn't buy the low at 360 in Dees corn, and now he's wondering if he should buy it here at the 470 price level. I think that there's a supply problem, and eventually Dees corn is going to trade over $5.
Soybean futures have followed corn. Why are prices rallying despite the fact that China is not buying U.S. beans and there are world record supplies?
We've had a similar $1.30 rally in bean prices during this wet weather, and I think the number one thing is that you've seen some agronomists feel that with certain percentage of the crop, let's say 20% of the crop planted after the 1st of June, that the yields aren't going to be there. The soybean plant is a very photosynthetic, sensitive plant, and yields start coming down when it runs out of growing degree days. So we could actually see a yield lower, we could see the carryout lower, and despite we're not having the exports to China, despite the record world supply, you could see soybean prices trade higher along with corn prices.
And this week, the USDA will have their latest update on the U.S. 2019 planted acres by crop and their June 1st stocks. What is the market expecting, and what impact will it have on prices?
I think the market is looking past these numbers because the USDA gauged the farmers on June 1st. I don't think the farmer knew exactly the problems that he was going to have. They came out in the June S&D saying that there's going to be 3 million less acres. That's probably what they might say. As far as stocks are concerned, for the wheat and for the soybeans, they'll be record high. And for corn, it's similar as last year, which is almost for a modern day record high. So the stocks numbers should be bearish. The acres numbers might be bearish, but as a minute later we'll trade what the market feels is going to be the actual supply problems.
And what should farmers do at these prices, and what should the end user do at these prices?
Well, right now the farmer is bullish, and he's not willing to sell anything, and you're feeling that in the cash. So you kind of look at 2020 and say, let's sell a little cash out there. Let's don't sell what's in the inventory. We can't sell 19 crop because we don't know what it's going to be. But for 2020, you could start selling some wheat, corn, and beans out there. As far as end users are concerned, I don't think a meal user or an oil user needs to panic. I think eventually prices might come down in the bean complex. Wheat is definitely overpriced, so they don't really need to run in here and buy the wheat flour. It might go lower. The problem here is that there's some quality issues. In hard red winter wheat, they may have to buy spring wheat to blend, but in corn, they probably need to get some ownership because I think prices are going to go higher.
Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of Archer Daniels Midland Company or ADM Investor Services. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.